Hello and welcome back to a new episode of the CTO Show with Mehmet. Today, I'm very pleased. Joining me from the West Coast in the US, Stanley Leong. He's a private wealth advisor and author. The way usually I like to do it, Stanley, I don't waste my guest times, in fancy, lengthy intros. I keep it just to them. So just tell us more about you, your background, your journey, and what you're currently up to. Before I give you the floor, just as the audience might guess, we're gonna talk about wealth, we're gonna talk about finance, we're gonna talk about, but for technical people who are usually, and I was one of them, I wasn't aware of this, so we're going to discuss these topics with you today. Again, thank you again, Stanley. The floor is yours to give us your intro and then we can start the discussion from there.
Awesome. Thank you, Mehmet. I appreciate being here. I'm looking forward to it. So I am a former engineer turned financial advisor. I have a master's degree from Cornell for electrical engineering. I designed computer chips for IBM for a couple of years in the late 90s, and then moved out here to California to work for Agilent Technologies, doing the same thing. And in 2002, I bought my first house here in California, and I moved in on a Saturday. Sunday, I was sitting in my living room, patting myself on the back, so proud of myself having bought my first house. And then Monday, I went into work and got called into my manager's office and got laid off. And so a very stressful time for me financially, of course. And I didn't know what to do. Do I sell the house I just bought? Do I cash out my 401k and pay my mortgage? And I think the most frustrating thing for me was just I didn't have anyone to go to for help, right? I'd ask my parents, they said one thing, asked my colleagues, they said another, asked my friends, they said something else. And so I was really frustrated, didn't know what to do. As I was looking for more engineering jobs at the time, I came across an ad for a job opening as a financial advisor at a large financial firm. And I remember thinking, oh, that might be interesting, right? Not only would I get to learn to do, what to do for myself, but then I could also help other people in similar situations with their finances. This was 2002. The tech bubble had just burst. Lots of people were getting laid off. Lots of engineers were getting laid off at that point. And with the encouragement of my girlfriend at the time, who's my wife now, I went in for an interview, somehow got past a couple round of interviews, eventually got the job offer. And I still remember driving home from that offer thinking, how hard could it be to be a financial advisor? And the next 3 years of my life were the most miserable years of my life. And so partly you're starting a new business, right? Starting to build up a client base, so all the growing pains of starting a business, working 60-hour weeks, not making any money. And then I think at the time, the thing that really was difficult was just back then we got all of our clients through cold calling. And as an engineer, I didn't even know what that was. So I didn't realize how miserable it was just to cold call. And so after 3 years or so, it started affecting my health and even my relationship. My wife was giving my resume out behind my back to her engineer friends, hoping I'd go back to engineering at that point. And then in 2006, I took the leap and became independent. So I became an independent franchise owner of a large financial firm, which is where I am now. And things started getting better at that point. I started getting my feet under me, started getting more technology professionals as clients. Eventually wrote a book, which was published last year, Engineering Your Finances. And fast forward to today, now it's wonderful. Now I love it. I can't imagine doing anything else. It's so rewarding I get to help people reach their financial goals in retirement. I look forward to going to work every day. And now I recently got best-selling author with Amazon, and I'm a go-to advisor for tech professionals. I feel so blessed to be where I am today. And so, getting laid off was in hindsight, one of the best things that could have happened to me. But of course, it didn't feel like it at the time.
Yeah, of course. Like this is a repeating theme, I would say. With like it happened to me a couple of times before in my career. It happened to a lot of people I know. Yeah, and when you look back, you start, as they say, connect the dots.
Yeah.
And turns out to be the best thing that happened, of course.
Right.
But with all the struggles that you have to survive, now it's a fantastic story, Stanley. Like how you did this move. Um, Speaking about from maybe your experience, I mean, your personal experience, and of course, now you see a lot of other people. Let's focus a bit on the techie people, like the
Sure.
engineers, right?
Yep.
Uh, and I was telling you, like, even myself, I didn't have this good relation with anything related, to finances, because I'm not sure about it in the US, but the part of the world where I grew up, usually, like, like, yeah, you are the engineer, like, you are the geek, like, you are the guy
Yep.
who thinks big, like, you shouldn't care about all these other stuff, which is wrong.
Yep.
Now, what other, like, wrong thoughts, or let's say wrong habits, have you seen, like, especially techie people do when they think about their finances?
Yeah, yeah. There are actually a lot of mistakes, a lot of similarities. First of all, with technology professionals in general around their finances, which also means they make a lot of similar mistakes around their finances. And yeah, there are several. I'd say maybe the most common one is I find a lot of tech professionals have a lot of risk in in their investments in their portfolios. Sometimes that's intentional, but oftentimes it's unintentional, and they really don't realize how much risk they're taking until I point it out to them, and then they're just as surprised as anyone. So, so I would say the first and foremost, what I find a big mistake tech professionals make is they take a lot of risk in their portfolios. Sometimes this is in the form of concentrated stock in their employer. Which is maybe the most common thing I see, especially if it's someone working for a large tech firm. And then the other concentration I see a lot is just in technology stocks in general, right? Technology is what they live and what they know. And so you generally like to buy what you're familiar with. And so you buy technology stocks. And then you buy a couple of them. You don't want to just have all your money in one stock. So instead of buying just Nvidia, you buy Nvidia and Apple and Google, and then you think you're diversified. But still, you're taking a lot of risk, even if you're just in tech, even if you have several different stocks, but you're just in technology. I think most people don't realize how risky and how volatile the technology sector can be. And so that's a common. We can certainly talk about solutions as well, but that's a common issue that I see. I would say that another one that's more related to retirement planning is in the tech field. Oh, in most other industries, the older you get, the more valuable you are, right? The wiser you are, the more experience you have. In tech, though, it's not quite the same. A lot of the tech firms, they actually value the younger people, right, that are just getting out of college, that are energetic and know all the new stuff. And as you get older, you kind of become a dinosaur in the tech world. And so that does change kind of the way you look at retirement and retirement planning. I have a client that, for instance, a couple years ago, he was in his late 50s, and he got hired onto Google. And he used to joke that he single-handedly brought the average age of the Google employee up because everyone he was working with seemed like they were in their 20s. And so, so that we do have to kind of plan for that. And if you get laid off in your 50s, it becomes much harder to find a job than in your 20s. And so that's another common thing that I see with tech professionals.
So can we say, Stanley, that they try to optimize their finances the same way we think how we can optimize a code, maybe, or how we optimize a system? Is this like part of the problem?
Um, I wouldn't say that's part of the problem. I think the problem is more with finance. There's just so much. So the technical part of wealth management is actually not that difficult. I tell people all the time, especially my engineer clients, they're really smart, they're real technical, they're analytic. And the analytic part of finance is actually not that difficult. It's you don't need to have a PhD in math or finance to understand how to manage money or how to manage your personal finances. The difficulty is that there's so much. It's just you have to worry about your uh, debt strategies and your investments, and then insurance, and then taxes, and then estate planning, and there's just so much you have to know. And so I guess you could say because analytic folks like engineers tend to try to want to understand how to do it themselves, it becomes overwhelming very quickly. And then they end up just procrastinating and not doing it, or just doing little parts of it because it's just too overwhelming. And then that's when mistakes are made.
Right. Now, you said you focus mainly on people who are, like, let's say, in their 40s to 60s,
Uh,
right?
Yep.
Uh, so if, and I'm focusing on the, of course, like, we're going to talk about the solution in a while.
Sure.
But you know what I like to do is I like to highlight how important this is by highlighting the problem, right? So we need to uncover this more and show it that it's a real pain. So first of all, and I'm gonna try to make it in one question instead of two. So
Okay.
once you reach this stage, so uh what is the strategy should be looking like compared to when you are like in your 20s and your 30s, and when you have to diagnose, like these problems, where will you see the flow? So you talk about a couple of them, but uh, do you think they are approaching this in the right way in the first place, or are they, especially now we live in an age where, some people might go and ask friends, some people might go and read some blog posts. Maybe now they are using AI for this.
Yeah, absolutely.
So, right. So where do you see the flaws in their way, how they design their own financials, in your
Yeah.
opinion?
So yeah. I think having an analytic approach is good. But yeah, I would say oftentimes when they're in their 20s and 30s, they're not even thinking about longer term type things. They're just sort of in a I would call it kind of more gambling mindset. They're just trying to make as much money as they can, as fast as they can, and who cares about retirement? That's so far in the future. I'm not worried about it, and and you're right. I think what happens is that kind of once you get to your 40s and 50s, now you start worrying about things like retirement and longer term. Um, but you still kind of have this younger mindset, especially when you're an engineer. You're in this fast-paced industry. You're it's go go go, and so you still kind of have this mindset of more of a gambling type of mindset. So one of the things I do clarify, try to make very clear with clients when they first become clients of mine is there is a difference between gambling and investing, and so we clearly define the difference and then make sure that they're not doing that. But yeah, and I think that might be where the aggressiveness level comes from with the technology professionals, is just because they're used to go go go. They're used to taking more risk when they're younger, and as you get older, you have to transition that mindset, and a lot of folks aren't able to transition that, or don't realize that they have to. Um, Part of the reason I wrote the book, in fact, just kind of bring up what you were saying, is because just timing wise, we are in that information age, and especially the engineers, they're always looking online and looking at other people and trying to figure out their finances. And there is a lot of really good information out there. And as like I said, now they're asking AI, right? And AI sometimes gives a really good answer and around finance, but sometimes AI gives a really ridiculous answer that's just obviously wrong from the beginning. But then it's that in between where AI gives what sounds like a good answer, but how do you know if it's right or not, right?
Right.
And same thing with anything online that you read. There's a lot of good information, but there's also a lot of information that's old or not good. And so I wrote the book as a way to help engineers navigate that. I have a client, for instance, just recently, a year or two ago, I had recommended a relatively straightforward tax strategy. Their accountant actually emailed me a month later and told me that I couldn't do this, and it was going to cause all these problems with their taxes and so forth. And they referenced an article online that kind of supported his argument. And so when I looked at the article was written like 2012, and it was correct for 2012. But a lot of tax laws have changed since then, and it's not correct for 2025 or 2026. And so if an accountant, a CPA, can get confused with their taxes because of all the information on that online, I can just imagine a normal person trying to do their retirement planning. How difficult that can be. So the book I wrote was kind of a way to help engineers kind of cut through the noise and get to the right answers faster.
Right. Before I deep dive with you on the solutions and the book,
Uh-huh.
one final thing regarding also the misconceptions, because you mentioned tech. You are in California. It's the capital of the tech.
Yep.
So we see these. And by the way, it's not only in California or in the US. Like even in other parts of the world, when you are in tech, we know like you are paid well. Like whether you
Yeah.
are an engineer, whether you are a manager, leader, so some people think, okay, you know what? Like I have a very high income. Why I even should even care about like, all this planning? I have financial security. How
Yeah.
dangerous is that, Stanley?
Yeah, very. Yes, that's very dangerous. When you think about retirement. So actually, one response I often get with the younger folks when I say, hey, what are you doing for retirement? Or when I ask when they think they might retire, when they're younger, they say, oh, I don't think I'm ever going to retire. Right. I love what I do. I love this engineering thing, working at a startup. It's exciting. I'm just going to work until I die. And so that's a very common answer I get for the younger folks. And then it's the opposite. As you get into your 40s and 50s, like, oh, well, I want to retire early. And so, I think to think that you can never retire, you're never going to retire, or you don't need to plan for it, I think is definitely a big mistake. One way I just think of it, retirement, if you retire in your 60s, you've got 30 years left in your life. It's like you're taking a 30-year vacation. You're saving money to take a 30-year vacation, right? You're working for maybe 40 years to take a 30-year vacation. So you do need to save no matter how much you make in order to make that happen. And so, I think it is very important to think of planning. The other important thing about planning, especially around investments, is the power of investing in the end is really the compounding over time. And the longer you can compound, the better. One of the things I show younger folks just to get them excited about investing is if you just save, I show them a spreadsheet, right? You just save $200 a month from ages 20 to 30, and that's it. And then you're not saving more. You have $1 million, assuming 10% growth and everything, you have $1 million at around age 60, right? And so, and it's because you saved so long ago, and that time and compounding gets you to $1 million. And so when you decide, I don't need to save right now, I'm making lots of money, and then, you're in your 40s and 50s, you don't have that time to compound anymore. And all of a sudden you have to save so much more money just to get to the same place. So the planning early is a really big help in retirement planning. But it's difficult sometimes when the attitude is, I don't have to worry about it.
Right. Now let's talk about the solution. Like, let's talk about engineering your finances.
Yep.
How, and feel free to give us as much details as you want.
Okay.
How that actually means in practice. Like, is there a certain framework people need to follow? How that starts and how it looks like in practice, Stanley.
Yeah. Yep. So I can start high level, and then we can dig
Sure.
down as detailed as you like. As I mentioned, it can be very overwhelming. There's so much you have to take care of with personal finance and wealth management. And so the way in the book, the way I break it up is I break it up into what we call the 7 key areas of financial planning, which we can go over if you like. But I break it up into, in a sense, like bite-sized pieces, right? There's that saying, how do you eat an elephant? One bite at a time. And so it's much easier if you can just attack one thing at a time rather than just trying to take care of the entire thing as a whole. With the caveat that each one of those parts, they tend to affect the other parts as well. So sometimes I think of it as like gears in a machine. One gear's turning affects how the other gear turns and so forth. So they do affect each other. You have to kind of take that balance into account. But if you can attack one thing at a time, it makes it a lot easier, less intimidating. Those 7 key areas are essentially determining your current financial position. This is like looking at things like your net worth and cash flow, debt levels, and strategies. We always say, if you want to figure out how to get to where you want to go, the first thing you have to figure out is where you are now. And so that's sort of where you are now. There's investment management, of course, and risk management, which we can definitely delve into. The third one is protection planning. So that's looking at your insurance coverages, home, health insurance, auto insurance, liability insurance, and so forth. The fourth one is workplace benefits. Fifth one is tax planning. Sixth is retirement planning, and the seventh is estate planning. And so, by breaking it up into those pieces, it just makes it a little easier to attack each one. I also do recommend attacking them sort of systematically, like an engineer would. The way my practice is set up, for instance, for our clients, we have 2 meetings a year. The first one's in the spring, and that's specifically focused around tracking your goals and protection planning. And then the meeting in the fall is specifically around taxes and investment strategy. And so we're very systematic and focused every year on making sure we cover everything and make sure we're getting all the strategies incorporated. So at a high level, that's kind of how we attack it systematically. And then within each of those categories, we certainly have different ways of approaching it and making sure that we're doing the right things for the clients.
Right. I'm gonna, focus on one area specifically, which is the risk, right?
Yeah,
And the reason
absolutely.
I want to do this for multiple reasons. Of course, and I'm an engineer by trade, as you say in the US. Um, so anything I approach using data and logic, right? Including risk. Now the other thing is there's another factor which is emotions, right? And the fear and the greed as well. We know like these
Yep.
two, move things usually.
Yep.
So how much time you need to spend, Stanley, on managing these two, I would say, factors when we talk about the risk specifically. How important is we make sure that everyone is on the same page, let's say, regarding the risk assessment, and do they really understand this? And I'll tell you something, because there is a group here in the UAE, and people are part of it. I'm part of it also as well. About like I think they call it FIRE, like financial freedom, and
Yeah,
something.
financially independent, retire early. Yep. Yep.
Yeah, exactly. So, and the thing that, for example, specifically now with all what's happening geopolitically and so on. So the first thing you see people they do when such event happen is they panic, right? And while the more wise guys they would tell, no, it's a long-term investment, like better you don't go to the screen and check it. Like,
Yep.
but as engineers we like to look at
Yeah.
screens,
I read
Stanley.
it. Yep.
So
Absolutely.
how you advise your clients, I would say, to manage this fear, greed, risk, you know tell
Mhm.
me more.
Yeah, yeah. So that's exactly right. Risk and emotions are very much tied together. And yes, I spent a lot of time actually. I would say almost most, especially in the investment side. All the different categories. When you talk about investments, um, I'd say the majority of my time when we're talking about investments, it's around risk and emotion. So yeah, so a couple ways. First, something just to point out. I know oftentimes when people hear that I work with technology professional engineers, they think, oh, these are very analytic people. And so emotions must not affect those people. And I would say it's almost the opposite. What I found is the more analytic and logical you are, the more emotional decisions you actually make. If only because, they're just saying that you make with finance, that, you make emotional decisions with finance and then you later rationalize it with your logic. And analytic people, engineers especially, they are so good at logic that they make emotional decisions and they can convince themselves that their logic is sound and rationalize their own emotions. So I found analytic people actually make the most emotional decisions of anyone. And so we do spend a lot of time trying to manage that. I even have a designation, a BFA designation, which is behavioral financial advisor, which there's a whole field of study, in fact, on behavioral finance and why we make sometimes irrational money decisions because of our emotions and our brain. And so, that's definitely a big part of it. I would say one of the things that I do with my clients is when we look at their portfolio and either the way they have it or the way we want to design it, one of the first things we look at is if something bad happens. Let's say we had another 2008. 2008 in the U.S. was one of the worst recessions since the
Yes.
Great Depression, one of the biggest, sharpest drawdowns in the market. How would this portfolio have done? Right, and then let's say it was kind of a moderate risk level. That portfolio might have lost 20 to 30%. The broad stock market in the U.S. lost over 50% from peak to trough during that time. And so I show them that, and I show them from a dollar amount. Okay, you have $1 million. Next year, 2008 happens to happen again. That means you're losing, $300,000, $400,000, or if it's, $10 million, now you're losing $3-4 million. And so how do you feel about that? Right. And I just sit back and let them stew on it. And, if they say, oh, that really makes me uncomfortable, I would panic, I'd pull out, then maybe we're taking too much risk. Right. And so then we can have that discussion. Whereas some clients will be like, no problem. Lose $3 million, no big deal. In fact, I want to invest more now. The stock market's cheap, right? In which case, okay, maybe this is the right investment risk level for you. Most people don't say that. Most people are on the opposite end of it. And especially when you put it as a dollar amount, it becomes real to them, right? 30% loss, what does that mean? But losing $3 million, well, now that can be a big deal. So I make sure to go through that with the clients. And I think that's a really good exercise. The other reason why it's a really helpful exercise is later on. The other thing, one of the things we learned in behavioral finance is we are actually really bad at determining how we'll act in the future. We think that, oh yeah, no problem, stock market drops a little bit, I'll be okay. But then when it actually happens, we act very differently than we think we'll act. And so even though they say, oh yeah, 30% drop, no problem, is that really the case, when it happens? But I think the fact that I'm going over it with them during a time that's not stressful, when times do get stressful and they do lose 30% later on, they can at least sit back and say, oh, Stan talked about this. Okay, we're okay. Don't panic. So I think just going over that, and if you're doing it yourself, just kind of understanding how big of a loss would your portfolio take in a time like 2008 or the tech bubble, and put it as a dollar amount so that it becomes real to you. And then really ask yourself, is that something you're willing to ride through?
Right. Now, one thing I think we didn't touch much on, everyone knows, and even if you are not in the US, every tech company, and this has become like part of how you attract talents and you keep them, is to provide restricted stock options like
Yeah.
RSUs. Some people, they give the stock option itself. They give you, it's called like you can buy at a very like discounted price, of course, when you
Yeah.
join the company. You have concentrated equity as well. Look, there are multiple ways, and all of them, some people, they think it's part of an investment, right?
Mhm.
I heard a lot of people, they say, like, I gotta be in this company for the coming 4 years. My equity will vest with time, or the company will go public if they are private company. And this is like kind of my plan. Like,
Yeah. Yeah.
let's talk about risk again here, and
Yeah. Yeah.
the need of diversification.
Yeah, I think that's even a harder one emotionally when you talk about emotions again. And so, yeah, that is one of the issues I see. I had mentioned, taking too much risk is a common issue. One of the reasons is because of that concentrated stock. And it's just like you said, it happens. I think for the most part, people don't intend to have uh, take that much risk. But you started a company, either just like you said, they give you the RSUs. They might have a stock purchase plan, like you said, if they can buy it at a discount. All of these things are good, So we do recommend doing those things. But then they're working 5, 10, 15, 20 years. They've accumulated over time a whole bunch of shares, and on top of that, if the company has done well, gone public, whatever, now that's the stock price has skyrocketed, and now, over 50% of their net worth is in the company stock. We recommend having less than 10% in any individual stock. And actually, I say 5% is a better number. So yeah, 50% of your money in one individual stock, that's a big risk. And people don't realize it. I just got a client last year, pretty high level at a tech firm, a large tech firm. And he said he had about 10, 20% of his money in stock. And he was worried about that. And when we inventoried his assets and investments, it was over 50%. and he was just as surprised as I was, right? So I think it sneaks up on you. You're not keeping track of it. You do some mental accounting, but that's it. And all of a sudden, the majority of your net worth is concentrated in the stock. And so, yeah, it is an issue with a lot of tech professionals. Back to the emotional part too, it becomes very difficult to sell. One, you feel kind of a loyalty to the company. Another story, I have a client, this was years ago, this was 2006 or 7. She came to me, she worked at a tech firm, and she was in her early 50s. She wanted to retire early at 55. And so we ran her numbers, and turns out she could. She's a really good saver. She had a decent amount of assets. She had a couple properties as well. And so it turns out the numbers work. She can retire at 55. And so she was super happy. And I told her, but she had the vast majority, and this was maybe 70, 80% of her net worth in her company stock. And I said, all of our numbers here assume that you're in a diversified portfolio. So we really need to sell some or most of that stock. And she said, okay, I'll sell the stock. And so, 6 months later, I meet with her. I was like, how did it go? And she said, oh, I haven't sold the stock yet. And so I went in and I helped her sell some of it, like within her 401k. But then she said, "Oh yeah, I'll sell the rest later." And then so same thing. We meet, and she still hasn't sold. And finally, I'm like, you know, this is a lot of risk you're taking. Um, and she admitted that, you know, she just emotionally, she felt like she had worked at the company her whole life. She felt loyal to the company. The company's gotten her to where she is today. She felt like selling the stock would be like she's being disloyal to the company.
Oh,
Yeah. And I told her, you know, CEOs sell their stock all the time, right? It's not a disloyalty thing. It's just a smart financial decision. But so she didn't. And then 2008 happened, stock price plummeted, and it actually delayed her retirement 10 years. She wasn't able to retire until 65 after that. And so she's retired now, and all is good. But you know, that was a painful lesson for her. And unfortunately, that's one of several stories I can tell where people have concentrated stock, didn't diversify. Part of it is the loyalty. The other emotion that comes is just in selling stock. You know, when the stock has gone up, you think, oh, I can't sell it. It's on its way up. It's going to keep going, right? You always just think it's just going to keep going up. And if you sell it, you know, most places you have to pay taxes on the gains that you made when you sell it. And I don't want to pay, it's a big tax bill, especially if the price has gone up a lot. And so I don't want to pay the taxes. And so they don't sell it. But then if the stock is down, they don't want to sell it because then they think it'll just come back up. And so I can't sell it now. And so they're emotionally, again, there's just no good time to sell from an emotional standpoint. So I do spend a lot of time with clients trying to figure out how to diversify that stock in a way that either we can help defer the capital gains if that's necessary. Sometimes I just tell them, hey, just pay the capital gains. That means you've made a lot of money. That's not necessarily a bad thing. But that is one big issue that we see.
right. One topic we didn't too much, went into. We just like touched the surface, and it's like the area where you focus more. Now, of course, I gotta give myself as example only. I don't live in the US, but let's say um, I came to you, Stanley, and I told you, hey, look, Stanley, I'm 46. I work with one tech firm, but I'm very, very, very behind on my financials. I mean, in terms of savings, investments. Usually, of course, other than running the first thing you mentioned, up the debt, the assets, like, are there usually some kind of 2 to 3 moves usually you advise them to immediately do? For, let's say, for me, I said, hey, this is how much I earn. I'm just making up numbers. Like,
Mhm.
I earn maybe, let's say, $300,000 per year. I work in a tech firm. I have some stock options, but you know what? I didn't save.
Yeah.
I'm running, check to check.
Yep.
Uh, what I should be doing immediately.
Yeah. So save, first of all, but a lot of I'd say a lot of tech firms, at least in the US, offer some pretty good tax savings plans for employees, especially if you're a big tech firm, Apple, Google, Amazon. They usually offer something called an after-tax 401k. So it's
Yes.
yeah. Okay. So if you're familiar with that, so they have the regular 401k where you can put up a certain amount and either pre-tax or Roth. And then on top of that, there's this after-tax 401k. A lot of clients, engineering folks, are not aware of that, and that is above and beyond your regular 401k contributions. And then there's a whole strategy around you take that and then you can convert it to Roth, and it's known as the mega backdoor Roth in our industry. And so that's a strategy that's very useful for engineers. And most big tech companies offer that to their employees. So that's a big one that's often missed, that I would say certainly, and especially if you're behind in savings, that's a really good way to build up savings and investments in a tax-free manner. In the U.S., at least, as your income is higher, if you're making 300,000, for instance, in the U.S., you can't contribute directly into a Roth IRA position where the money comes out tax-free. And so it's a little more difficult to build up that sort of tax bucket. But if you have that after-tax 401k, it's a really good place to go. So that might be the first thing I look at to see if it's available for you, and then encourage you to try to start saving into that. The employer savings is good, not only from a tax standpoint, but just because it comes out automatically, right? So you don't see it, you don't feel the pain, especially if you're used to living paycheck to paycheck. Saving can be hard because now you have to maybe cut your lifestyle And so something like an employer-sponsored plan, it really helps make it easier emotionally, if anything else.
Right.
So yeah, so I'd say saving into something like that, making sure, now with that, there is some strategy around that. So make sure you're doing it correctly. And then again, I would say likely you have lots of concentrated stock as well. And so making sure that's diversified, especially, you're 46, you're not that far away from retirement, at least not as far away as it used to be. You really need to start looking at making sure you're not taking too much risk. Even the technology sector, for instance, I think what most people don't realize is you can still lose a lot of money, even if you're in the technology sector as a whole, during a bad time. When the tech
Right.
bubble burst, most people, some people understand like the broad market, like the S&P 500, lost maybe about 50%, from peak to trough. The tech sector lost over 70% during that time. So you're getting close to retirement. You can't stand to lose 70% at that point. If you lose 70%, then you're not retiring anytime soon for most people. So I'd say the first things I would look at that just come to mind for me is looking at the concentrated stock and diversifying that somehow, and then looking at savings programs, after-tax 401k, IRAs, whatever it is, to start building that up as soon as possible. And then even if it's a smaller amount, let's say we run your analysis, and because you haven't saved, you need to save several thousand, 4,000 a month, and that you just can't do that from a lifestyle standpoint. Even if it's just 1,000, even if it's just 500, even if it's just a little bit, just getting that little bit in there. One, it helps the habit of saving, but then two, that little bit over time can still turn into a big amount.
Right. Now, I know like usually you don't focus maybe on much on these folks, but just out of curiosity,
Yeah.
if I'm a tech founder, right? And maybe I'm not saying I'm early stages, like I crossed the chasm, let's call it this way.
Yeah.
Uh, when I should be focusing on making this priority, like it's for me and for my team. Maybe we are just a small team now. Maybe we are like 10 people, and yeah, we have raised money and business is going good. But yeah, we are into this excitement of everything going on, and I see a lot of founders they forget this, and often also like CTOs, senior engineers, like the first people in the company.
Yep.
When you would tell them to prioritize this?
Yeah, great question. And I do work with some founders as well. They when they should prioritize it is yesterday, is as soon as possible. It's the way I like to think about it is, when you found a company and you own a company. I mean, I own my company, right? So I understand that. Um, uh, it's the same as owning one stock, right? You own the company. And so
True.
it's that is also concentrated risk. And as exciting as it is, and as optimistic as you are about the future of that company, you also know anything can happen, right? Who knows? And then especially in the tech sector, anything can happen. I've seen many founders who thought that their company was going to be sold to a big firm like Google for $10 million, and at the end of the day, they ended up getting like $800,000 out of it. and so, right. And so you see that often, and the other thing can happen as well. But again, I always like to look at things from a risk standpoint. And so one thing I like to think of it is, okay, this is concentrated risk that you have as the founder of the company, and you own the company. And it's also a risk you can't diversify, right? You can't just sell the stock and because it's
Right.
not a public stock. But you should still think about having money on the side that's saving for retirement, that, even if your company doesn't go the way you want, that you're still able to, live the rest of your life and retire and everything like everyone else. And so, so it's the same idea, even as a founder of a company, hopefully at some point you're making enough money that you can save, and you want to save, and you want to put aside just like everyone else, you want to put aside the money that you can for your financial goals, helping your kids through school, or helping you retire, and so forth. And then you think of your company as icing in a sense. It's your human capital. It's where your income's coming from now. And if it takes off and you get huge valuations and you end up getting a lot of money for it, then wonderful, right? That's great. But if it doesn't, if you have this savings on the side in a diversified portfolio, just like everyone else, then you're okay as well, just like everyone else. So, I encourage people to think of their company as their human capital, like the money that they're making now and allows them to live their lifestyle now. But don't depend too much on that as your retirement, because especially in the tech field, of course, anything can happen.
Great advice, Stanley. Now, traditional final question for you: where people can get in touch, where they can get the book, and any final call to action you want to give us today.
Yeah. So I'd say final call to action again. Just you brought it up first, but I think it's really important is risk. Risk is, I think for most tech professionals, risk is the thing you want to pay attention to. One of the things I like to tell my clients is there is a very clear definition between gambling and investing. And there's several ways you can define it, but the way I like to look at it and explain it is when it comes to gambling, you're looking at the potential return of something, and risk is secondary or sometimes not even considered. When you're investing, your risk is first and foremost your consideration. That's the highest priority. I always like to say, as investment managers, we call ourselves investment managers. Really, we're risk managers. Investment manager just sounds better, sounds sexier. So we call ourselves investment managers. We're really risk managers. And so at the end of the day, you should be, if you're investing, you should be looking at risk first. And we still want to make as much money as we can, but within the context of that risk. And so one way you can test yourself on that is if you're looking to put money into something, the gambler, the first thing they think is, oh, I wonder how much money I can make. How rich am I going to be? What kind of car can I buy? And so forth. A good investor, whenever they're putting money in something, the first thing they always think is, what if I'm wrong? What if this doesn't go the way that I want? And how is that going to affect me in my situation? And if you just think of things that way, even if you don't know how to evaluate risk, but you just think of things that way, you will probably be a better investor than most most people out there. So that would be maybe my tip for tech professionals, especially on investing. To find out more or to get my book, I do have a website, engineeringyourfinancesbook.com. And so there's a free audiobook version of the book on there as well. The book is on Amazon if you want a hard copy, or I'm happy to send you a free one as well. If you want to reach out to me, or with any questions as well, my email is stan@engineeringyourfinancesbook.com. And then we can go from there.
Great. I will make sure that the link and everything you mentioned is in the show notes. So if people are listening on their favorite podcasting app, they can find the links in the show notes. If you're watching this on YouTube, you will find in the YouTube description. Stanley, thank you very, very much for sharing this. I think this is important. I covered, but that was long time ago, and I'm happy that we did this again today, because I think the last time we discussed finances for founders and for tech leaders was maybe 2 years ago, on the podcast. So it was a great way to refresh and have a engineer view, like from someone who lived in the trenches, as they say.
Yep.
And I'm happy that you shared your thoughts. Of course, as I mentioned, people can find the book on the link that Stanley mentioned. It's in the show notes. Again, thank you very much, Stanley. And this is how I end my episodes. This is for my audience. If you just discovered us, thank you for passing by. Small favor, just share it with your friends and colleagues and subscribe to get, all the new episodes your way. And if you are one of the people who keep coming again and again, thank you very much for your loyalty. Thank you very much for tuning in. Thank you for recommending the show to people in multiple countries. This is why I see from the numbers we are getting in the Apple top 200 podcast charts across new countries. Some of them I've never been, even some of them, rarely we see them. So I'm happy we are reaching as much people as possible. This makes me happy. So thank you very much for the support. And as I say always, stay tuned for a new episode very soon. Thank you. Bye bye.